Hi, I'm Garrett Cayet, SFMG's Chief Investment Officer, here to provide a summary of second quarter market drivers and thoughts on the markets and economy as we enter the back half of the year. So the quarter got off to a solid start in early April when President Trump announced a temporary ceasefire with Iran. That news alone helped markets recover from the geopolitically driven sell-off in March, and it set a constructive tone heading into earnings season. And earnings did not disappoint. S&P 500 companies reported annual earnings growth of roughly 15%, which is nearly double the long-term historical average. An important detail is that the tech sector accounted for about half of the index's total return for the quarter. So while most sectors posted positive earnings and participated in the rally, the degree to which one sector once again dominated is worth understanding. Momentum then continued to build into June. Progress towards a formal ceasefire agreement between the U.S. and Iran grew steadily, culminating in a signed interim agreement on June 17th. Around that same time, excitement surrounding the SpaceX IPO provided some additional fuel, particularly for the tech sector and AI-related investments. The one meaningful headwind during the quarter came from new Federal Reserve Chairman Kevin Warsh. In the June press conference, the Fed signaled a greater willingness to raise interest rates to combat inflation. That higher for longer messaging did appear to slow the rally's momentum a bit as the quarter wrapped up. So what does all this mean as we head into the second half of the year? The short answer is we're optimistic, but of course focused on the risks that are still out there. The first risk centers around interest rates. At the start of 2026, the market widely expected 1 or even 2 rate cuts this year. Today, because of persistently elevated inflation, the market is actually pricing in rate hikes instead. And rate hikes are not automatically bad for stocks, but a hiking cycle, so multiple rate hikes, would very likely bring much more volatility back into the marketplace. The second risk is the market's growing dependence on artificial intelligence investment. Massive spending on AI infrastructure has been a genuine tailwind for economic growth. But if the companies committing all of that money begin to question the return that they are getting on their investments, a pullback in that spending would represent a real headwind for both the economy and markets. And finally, it's not just an AI bubble that could weigh on stock prices. While the U.S. economy has been remarkably resilient over the past several years, it is not immune to more traditional setbacks. A renewed rise in inflation could weigh on both consumer spending and the housing market. And at currently elevated valuations, stocks are still not leaving much room for economic disappointment. Bottom line, our focus remains exactly where it has always been, which is constructing portfolios built to navigate a range of outcomes and not just a singular best-case scenario. So while we're monitoring these risks, we're also staying alert to the opportunities that offer an appropriate balance of risk, return, and diversification. Thank you for listening, and if you have any questions about your portfolio, please feel free to reach out to your SFMG team. Thank you.